Welcome back. Today is the second day of our revision program for performance management for cima. I hope the first program was useful and you picked up important areas and tips for the exam. Today also we are going to talk about few more important areas in the syllabus, and then I will help you to enhance your skills in each of the areas, especially with a focus to answer the questions at the examination. We will start off with an important topic called activity-based management, which is dominated by two areas. One is customer account profitability, we call it the CAP, or customer profitability management, and the second one is the DPP, which is the direct product profitability. These are all spin-offs from the original concept of activity-based costing, later on discussed as activity-based management. Interesting to understand the roots of these concepts. Activity-based costing was, as we discussed in our first program, was predominantly brought in to cost a product accurately. Later on, mathematicians and management accountants argued why we use this activity-based system only to cost products. Why not we use it to cost customers, cost services, cost different processes, because it's the same concept. Take a cost pool, take a cost driver. Rather than allocating the cost to a product, why not we allocate the cost to a customer group and ask the question, what is the cost we need to service a customer? And as you know, with the modern IT systems and the modern ERP solutions, calculating the revenue earned from a customer or a group of customers is a very simple thing, because most of your invoicing will be done through a computer system, and every invoice you generate to a customer could be recorded, and as a result the total revenue could be easily worked out. So working the revenue from a customer is simple. Now, thanks to activity-based costing, we could identify the cost of servicing a customer to a great accuracy, because we can do the cost pools and we can allocate the cost. Now let's think of certain cost pools. Let's say customer service cost pool. There may be certain customers who would not want a lot of customer servicing support, because these customers have been with the company for a long period. They know the process, they know the systems, and you don't need a lot of customer service for these customers. But there are some new customers who walks in to the company, maybe to a bank, which requires a lot of servicing. So quite rightly so, out of the cost pool of customer service, more costs will have to be allocated to the new customers compared to the existing customers who are very well settled in. Simple example. So likewise, the total overheads could be yet again split among the customers. And like I explained earlier, the revenue is anyway very simple to calculate. Revenue minus the cost. Here we have a unique calculator called the profitability of each and every customer. And how important it is for a company to calculate the profitability of a customer. Very much so, because then it can group the customers into different segments and have different strategies to manage these customers. Now let's look at an interesting slide. Having calculated the profitability, I have explained in this slide, we could group the customers into three areas, like the high profitable customers, average profitable customers, and low profitable customers. Now high profitable customers, who are they? They are the customers who gives you lot of revenue but takes very little cost to service them. What do we do with them? Identify who they are and ask them what do they need, and give them what they need, protect them, keep them with your company. Simply make them happy. Make sure that they are protected, insulated from competition, build loyalty so they will not leave. A good example is, you will notice that most of the banks today have a special service for their key customers. HSBC call it the premier customer. Nations Trust, they call it the inner circle. Likewise, every bank has a system to protect their key customers. And who are they? They are the customers who brings the highest profitability, corporate or individual, to the organization. Let's look at a different set of customers who brings in average amount of profits. What does this mean? This means that the customers are bringing a reasonable amount of revenue into the organization, but at the same time they use quite a significant amount of cost also. So if you net the cost against the revenues, you will find that they are okay. They are having some profitability, but not to the level of the first category. What do you have to do with them? You need to have methods to cut down the cost from these customers and make sure that the gap between revenue and the costs are wider, so you earn more profits out of them. You could check the possibility of slightly increasing the selling price. You could check the possibility of selling more and more products to the customers, so therefore you get more revenue while maintaining maybe the same cost. So we need to have a different set of strategies to look after these customers. The third segment of customers. These customers bring a small revenue into the organization but takes a lot of costs away. So as a result, the company is not making profits out of these customers, right? Or maybe a small minute profit which is not significant. What do you have to do with these? These customers will have to definitely be re-engineered. You need to definitely increase the selling price. Maybe it's a good idea to give these customers to a competitor, because a competitor will suffer with these customers anyway. So you could have a conscious strategy to chase the customers away to a competitor. Re-engineer the cost, bring the cost down. If there is any additional service the customer wants, you could charge them. Increase the cost. If none of these work, you will have to take this painful decision to discontinue the customer. Let's look at an interesting graph where the examiner calls it the customer profitability graph. This is in your study stream, the syllabus. Let's look at the first gradient point of the graph, where the x-axis comes to 20% and the y-axis come to 80%. This is the first category of the customers. Small in number, 20% of your customers brings 80% of your profits. Let's look at the second category. 80% cumulative customers bring more than 100% of your profits. This is the average customers. Let's look at the third category. 20% of the last customers takes some profit away from your organization. So you need to manage them carefully, otherwise you will hurt the company. So examiner would try to test your knowledge on the concept. There could be a simple calculation as well, but the examiner more would like to ask you, having identified these groups of customers, what is your strategy? What are you going to do? The second concept of the activity-based management is called the DPP, the direct product profitability. The direct product profitability is very useful for retail organizations. Now, what are retail organizations? Retail organizations are organizations which buy a product and sell a product immediately. Think of an organization like that. Supermarkets. Think of Keel Super, think of Cargill's. Majority of their products are bought and within a short period are sold to people like you and me. Let's think of a packet of Anchor milk powder. It's bought from Fonterra's at a particular price, kept in Keel Super shelf, and so a customer comes and buys it. So the supermarket makes a small profit, that is the profit between the sell price and the buy price. Is that all? No. The supermarket will have to look after this product from its buying point until it's sold to a customer. This is called direct product profitability. That is the sell price minus the buy price minus the cost of looking after the product during that short period of time. Think of a supermarket again. When you buy a product, what are the three critical operations you will have to manage? You will have to warehouse the product, store it for some time. You will have to transport the product to the final store location. You will have to keep the product in the store before you sell it. So a DPP is the cost, DPP is the profit of the product after these costs are also allocated. Let's look at a simple example of DPP. Let's look at a slide where in this example we buy the product, supermarket buy the product at 180, sell it at 150, so make a gross margin of 70. But their warehouse cost is 16 cents, store cost is 18 cents, this is the final store where the product is sold, and the transport cost is 22 cents. So the real profit is only 14 cents. So this is the important concept of DPP. The gross profit minus the cost of looking after the product, which comes from three cost pools. So the examiner may check the concept at the exam even with a small calculation. So please revise DPP and CAP, customer account profitability, carefully before you go to the exam with the applications. We will take a small break and come back to discuss another section in the P2 syllabus.